that iconic photo of Jensen Huang signing a lady's, this is a family show, so we'll say signing her T-shirt at their investor day.
Although I think she'd removed the T-shirt.
These are just not things that happen at the bottom of markets. These are things that happen at the top.
For this episode, I'm joined by Duncan MacInnes, manager of the Ruffer Investment Company, for a conversation about his investment philosophy and how he thinks about risk in today's financial markets. He describes himself as a pragmatic, macro-informed value investor. The Ruffer Investment Company is a £1 billion London-listed investment company with a simple aim of delivering consistent positive returns regardless of how financial markets perform, with the ambition to protect and increase the real value of its investors' capital. A simple but challenging mandate. To achieve this distinctive objective, Duncan has a highly differentiated strategy and has constructed a portfolio that looks nothing like most other portfolios. Since launch in early 2000s, Ruffer has a good long-term track record. However, over the last couple of years, performance has slipped as risk assets, particularly equities, have outperformed Duncan's expectations. But Ruffer's performance has a tendency, as Duncan says, to perform like ketchup coming out of a glass bottle. The events of early August, as the yen carry trade sent markets in a spin, offered a brief glimpse of the better times that might lie ahead for this fund. Duncan offers a masterclass in different, often esoteric markets and how he has used instruments such as gold, FX, credit spreads, derivatives, inflation-linked bonds, and even Bitcoin to find uncorrelated returns and asymmetric and reflexive risk profiles. Duncan is positive on the outlook for gold, the yen, and commodities. However, he thinks investors are over their skis when it comes to US equities and the crowded Mag 7 trade. He is more positive on UK equities and describes why the consensual view that Chinese equities are uninvestable, and that draws him to them. As he says, we are all invested in China already, but at several times the value of most Chinese stocks. As ever, nothing you hear in this podcast is investment advice, and all the views expressed by the contributors are in a personal capacity only and do not represent the views of Progressive Equity or any other organisation mentioned in this podcast. Please enjoy my conversation with the maverick, Duncan MacInnes.
Brought to you by Progressive Equity.
Duncan, hi, thanks for joining us. Can we just start with what got you first interested in the stock market and in investing?
I'm always slightly embarrassed by answering these questions because so many people have these stories, sort of imagine them as like a mini Jacob Rees-Mogg sitting reading the FT at the age of 8, eating Granny's marmalade. I do remember my dad used to look up share prices on teletext, which probably dates me slightly. So I do remember that was a sort of daily ritual for him. He was a sort of DIY investor, but it never really captured my imagination, to be honest. I was just aware of it as a thing that was there. And so I went off to uni to do law. So I read law and I realized that I didn't want to be a lawyer. That was a clear takeaway from a few years of law. And to be honest, I got very lucky. I applied to a whole bunch of graduate jobs. I frankly chose the one that paid the best because it was pre-financial crisis. So it was still the glory days of banking.
Yes.
I stumbled into a job at Barclays and bounced around a few different departments in there as part of the sort of official graduate program. I literally joined Barclays in Canary Wharf 2 weeks before Lehman Brothers.
Oh, wow. Okay. Baptism of fire.
Born in a storm, I think is the phrase to describe that. So, of course, markets were the epicenter of everything going on in the world at that moment. And that got me really interested, that nobody has a clue what's going on. You know, so a sort of level of humbleness in the face of the uncertainty of markets is essential, and also has probably predisposed me to being a bear, or at least a cynic. So my Ruffer origin story was sitting at Barclays early in 2009 and looking at a client's portfolio that had been decimated by the financial crisis, and markets were pretty much at their lows in Q1 2009. And they had one holding in their portfolio that was on a gain, and it was the Ruffer Total Return Fund. So I was intrigued as to what that might be. So I went on the website, started reading Jonathan Ruffer's stuff, saw that Ruffer had done very well in the financial crisis. And that set me down a path where I started looking at, well, it is quite interesting that some people saw this coming and managed to make money from it. What do they have in common? What were they thinking? What were they doing? Maybe I should start learning from them. So I think that this sort of fed into my approach, which I developed myself, I guess, before joining Ruffer. I wrote a blog, given that I was 23, 24 at the time, rather grandly. I described myself as a pragmatic, macro-aware value investor. But so many narrow value investors got caught in the financial crisis, be it Eddie Lampert, Bruce Berkowitz, Bill Miller. These legendary value investors had huge drawdowns in the financial crisis. So that traditional value-only approach, refusing to even consider macro, because macro is very hard, seems to me a little bit too narrow. And also by reading books like Market Wizards and House of Money and all the macro pantheon, the library, I was just captivated by the creative and interesting trades and markets that those guys played in. So the combination of that made me think that combining macro thinking and a value philosophy or bias was the answer, because every decade or so markets have this huge drawdown, and that's something that you should probably try and avoid if possible, because the power of compounding makes it so damaging. So if you can compound but without the drawdowns, then you can end up in an amazing place. If you start to look at the world that way, which I did, there's really not many firms that actually do that. And Ruffer was one of them, one of the best, one of the longest standing. And so that was what made me pursue Ruffer. And I applied for a job at Ruffer.
You camped on Jonathan Ruffer's doorstep.
Well, it was actually...
Or did he read your blog and write to you and say, please come and work for us?
I wish Jonathan read my blog and gave me a job. That would be a much better story. No, I campaigned Hamish Bailey, who was the manager of Ruffer Investment Company at the time, for a job, and Hamish gave me pretty short shrift and was clearly not impressed by my blog. And then 6 months later, he came back and said, actually, things have changed. And so I snuck in the door. If you filter by who made money in 2008, you'll get a list.
Yes.
If you then filter that list by who also made money in 2009, a much, much smaller list. That has been important through the history of the firm that, yeah, well done on preserving capital through the crisis. But like I said, you want to harness the power of compounding over the long term. So you do have to take risk once risk has repriced to a more attractive level.
How do you think about the main risks out there today? What are investors' biggest risks? Is it inflation? Is it prospect of recession? The financial system is about to break, and
it could be all of those. Yeah. I think it seems likely that the solutions, inverted commas, to a recession, if we get one, or a breakdown in financial markets would be inflationary ones. They would be inflationary solutions. And by that, I effectively mean sort of returning to QE or bailouts or various forms of stimulus. So I think that you don't just get one of those things whenever the crisis comes, because the response to the crisis will be one that generates inflation. The way that I would characterize markets today is that they're quite avalanche prone. There's lots to worry about from a macroeconomic perspective. I think the risks of recession have not disappeared, although people have been pretty happy to compartmentalize them or put them to one side. And you can clearly demonstrate that valuations are very high, that investors are crowded into the same trades and positions.
Yes.
There's a homogeneity to investor portfolios. And I think also that you can make the case that everyone is slightly over their skis in terms of positioning. So you can look at fast money, things like futures positioning, or you can look at wealth manager allocations to stocks or household allocations to stocks. These things are all pretty close to all-time highs or at all-time highs. although it's quite hard to nail down exactly what the catalyst will be. We thought that the catalyst would be a recession in 2023. We thought the market pain of 2022 would translate into a recession in 2023, which would bring corporate earnings down, which would bring the next leg of the bear market. That was wrong. The market has climbed a wall of worry since then. I don't think the recession risk is off the table. It's not quite as acute maybe as it was. The Fed has a little bit more leeway to support markets if something bad does happen. But definitely, if something does derail the market, then the avalanche looks like it could be quite big.
So probably at this point, it's worth just telling us about the way the Ruffer strategy is set up in terms of broad asset allocation in order to best meet the circumstances that we're currently in and the future that you think might be ahead of us.
So the Ruffer strategy, one way of expressing that is Ruffer Investment Company, is a global multi-asset, go anywhere, absolute return approach. We deliberately try to keep the menu of what we can own in the portfolio as wide as possible. And what we try to do is build a portfolio that is a balance of protection assets and growth assets. And if you get that balance right, then you don't need to worry quite so much about market timing or about what's going on in the market or the economy.
You've got all bases covered.
Theoretically, but you are making subjective judgments about the relative attractiveness of markets, and you're making judgments about the way that assets will correlate with each other.
Yes.
The way that Jonathan Ruffer has described this in the past is that you're juggling hand grenades. And sometimes you can make errors in those judgments. And that's what went wrong in 2023, which was the worst year in our history, our 30-year history of the firm. Last year, we lost 6%. It was, well, a bad year, clearly. Yeah. And I think there's two ways that you can look at that. To be going for 30 years and to deliver 8% per annum sort of equity-like returns with bond-like volatility, and for the biggest loss in a calendar year to be only -6 is something to be really proud of. On the other hand, if you tell people that you're all about capital preservation and not losing money, and you lose 6% in a calendar year, you're not doing very well. You're doing a bad job.
Given Jonathan's colourful analogy about hand grenades, one of my recent podcast guests was a wealth manager called Tim Price.
Yes, I know Tim.
Who said that anyone who owns bonds currently is dancing around the edge of a live volcano. And this was to his concern about the rising levels of government debt, particularly in the US. How can these bonds ever be repaid in anything other than devalued dollars?
Tim has a big brain. I don't like to go up against him. So I think we agree with his point. I think there is a valid shorter-term investment case for bonds, but I would agree with his long-term concerns. So shorter term, why would you own bonds? You would own bonds because you are imagining a negative market or economic scenario and one that will be coupled with rate cuts. Now, I think that the attraction of that has lessened recently because there are now quite a lot of rate cuts priced into markets. There's 8 or 9 rate cuts between now and the end of 2025 priced into the treasury market. But if you think that the global economy is about to plunge into recession and markets are about to go off a cliff, then bonds will probably do quite well.
I mean, to your point, it does seem to me at the moment that bonds are pricing in a recession, but the equity market hasn't got the memo yet.
Yes. So we'll come back to that.
Okay.
That's definitely right. So I think the shorter term case for bonds makes sense if you have a very negative view. But it's also the reason bonds have been such a key part of people's portfolios for so long is that everyone assumes that stocks and bonds are negatively correlated. That's been the great trick of the last 30 years up until COVID.
The 60-40 portfolio.
Exactly.
Yeah.
And we've written lots of nasty things about the 60-40. I wrote an article called No, Mr. Bond, I Expect You to Die in 2021. And bonds did sort of die. They had their worst year in a century. 60-40 had its worst year in a century. Actually, the 60-40 is now back at all-time highs. But that's been mostly driven by the equity side rather than the bond side. I think the usefulness of bonds as a portfolio diversifier, you own bonds for protection, you own them for diversification, and you own them for income. I think the income element is better. The bond yield is 4 rather than 1.
Yes.
So the income element is better. The protection element is better, but not great. like I say, you need to imagine a very negative scenario, I think, for bonds to do well from here, given the number of rate cuts that are already priced in. And the diversification element is the one that I think no longer works. So we and many others have done work that show that when inflation is above 3%, stocks and bonds become positively correlated. They were positively correlated in 2022. If you believe our longer term macro view, inflation is probably now operating with 2% as a floor rather than a ceiling. Therefore, that correlation benefit that owning bonds used to bring to your portfolio is probably lessened, if not completely gone. That's the current setup. Longer term, I think Tim is absolutely right. We're big believers in financial repression. Therefore, nominal bonds are far less attractive. I would make the distinction that real bonds, so inflation-linked bonds, which are actually the duration that we own, are better. They do have a portfolio role, but they do also come with their own strengths and weaknesses. I think they're part of a solution. US tips are offering a real yield of about 1.7, 1.8 today. That's not bad. You can buy a 10-year bond, the US government, and it will pay you inflation, whatever inflation is, plus 1.7 per annum. That's okay. I don't think it's great, but I wouldn't be that negative on them. Now, to go back to the point you made about you said bonds are pricing in a recession, is that right?
I think bonds seem to be pricing in a recession, whereas the equity market is not so sure.
Yes. So I think one of the advantages of a multi-asset approach, a cross-asset perspective like we have, is that you can see what different asset classes are telling you, and then you can decide what you believe and which risks to take on. So I would say today that bonds are pricing in a recession. Oil looks like it might be pricing in a recession. Chinese equities, emerging market equities, look like they're pricing in certainly Chinese equities look like they're pricing in a recession. And gold is telling you something not quite right in the world. Bonds, commodities, oil and copper, possibly gold, Chinese equities are telling you all is not well, there's a recession. Yet you look at the S&P, you look at credit spreads, you look at volatility, very becalmed once again. They're telling you everything's absolutely fine, sunshine or rainbows. So if that's the setup, what we have decided to do is to buy the things that have already priced in the recession. So we have copper, we have oil, we have Chinese equities, and we own very little of the stuff that is pricing in sunshine or rainbows. So we don't have US equities or don't have much exposure to US equities, and we are getting our protection. We are short investment grade bonds via credit spreads, and we're long volatility as a hedge. So we are definitely positioning the portfolio for a reappraisal of the way that these assets are pricing things. Or at least if you buy an asset that's already pricing in a recession and a recession happens, your downside should be relatively protected. But if the world is better than it appears, then you should get a positive surprise. Gold is the canary in the coal mine, really, isn't it? I think it's telling people that all is not well, because it's now $2,550. And I think if you had a one asset portfolio to reflect the Ruffer view, gold is maybe it. But there's a really fascinating bifurcation, I guess, going on here, where the traditional methods that you might use to try and value gold, and gold is notoriously difficult to value, are telling you gold is expensive. Gold looks expensive relative to CPI inflation. The gold oil ratio, how many barrels of oil can you buy per ounce of gold, tells you that oil is looking cheap relative to gold. The rise in interest rates should have been negative for gold, but gold has sailed through that. And there's been a strong correlation over the last decade or so between gold and real yields, which is also quite intuitive. As real yields rise, gold should suffer because the opportunity cost of holding gold has gone up. That has also broken down. Real yields have been rising, and so has gold. So that tells you that maybe gold is expensive, or maybe something else is going on. Now, something else is going on is very close to an "it's different this time" argument. So I'm quite wary of making an "it's different this time" argument, but also it is different this time. There's different stuff going on. There's more geopolitical instability than we've seen in decades. Inflation has gone from a hypothetical problem to a real problem over the last couple of years. And we've seen a change in the monetary order. Sounds a bit grand, but new buyers have had to emerge because of the confiscation of Russian assets in the Western banking system. And February, March 2022. That was a shot across the bows to anyone who's a bad actor. All those people, be it individuals or nation states, have been incentivized to not have a deposit at JP Morgan or Credit Suisse doesn't exist anymore, Credit Suisse in Geneva, and instead to hold physical gold in their own jurisdiction. So you've seen these physical gold buyers from the East broadly, not the West. And I think those ounces are being acquired. They are disappearing into a vault somewhere and they're never coming back. That is a change.
So the opportunity for the value investor is probably, if you know what you're doing, is to buy gold miners at this stage rather than gold bars.
Agree. Although I think there's nothing wrong with buying gold, but I think you get less asymmetry in gold from current prices. So the gold mining equities basically are telling you, well, two things. First, the Chinese central bank is not going to buy Newmont or Barrick, but it might buy physical gold, or it is buying physical gold. But also it's possibly telling you that the market doesn't believe the current gold price is sustainable. The gold equities are pricing in more like $2,000 gold. And if you look at the sell side estimates, there is a fade down in gold in future years. I think there's far less froth and excitement in the mining companies. The mining index peaked in 2011, I believe, and is down 40%. So the gold mining index is down 40% since 2011. And in that time, gold has probably slightly more than doubled. So a huge crocodile jaws has opened up here, which I think makes the mining companies attractive. So we've got about a 5% exposure there. And we also have a little bit in the other precious metals, in platinum and silver. What gives me comfort in setting to one side the red flags of gold looking slightly expensive and gold having attracted some fast money in terms of things like futures positioning, is that I think the slow institutional money is still pretty underexposed. So if you look at the gold ETFs, they still hold vastly fewer ounces than they did at the COVID highs in 20 or 2021. That's something that we're monitoring. I think if that caught up, you're looking at tens of billions of dollars worth of buying for that to catch up. And you look at surveys.
All that capital's gone into NVIDIA and MacInnes. Yeah.
The fund manager surveys that Bank of America produce are always good reading. They show that 75% of wealth manager portfolios or multi-asset portfolios have 1% or less allocated to gold. That seems pretty low.
Seriously? 75%?
75% of portfolios have 1% or less in gold. So gold is underowned by conventional portfolios.
That's more underweight than in UK equities at the recent time.
Who would have thought we could find something more underweight than UK equities? And then the last point, and this is very much a Duncan MacInnes opinion rather than a Ruffer view, is that when I look at gold and the narrative around it is so perfect for the moment and the path of the economy that we see in the coming years, that I think everyone might suddenly realize this is the perfect asset and I don't own it. And so I think there's a decent chance that this cycle, this is why I caveat it as my own opinion, because I think it might end up looking silly. There's a decent chance that this cycle ends in a massive gold bubble. And therefore selling too soon because it's a little bit expensive might be a mistake.
Moving on, can you just tell us about the yen and why it's attractive?
So from something that's possibly quite expensive to something that's very cheap, the yen is the cheapest major currency in the world, almost without question. The recent peak in dollar yen was 161 yen to the dollar. The last time we saw that exchange rate was 1986, I think, or thereabouts, which was not far off when I was born. So it was a long time ago. Valuing currencies is hard. We know that. But on any attempt at valuing currencies like purchasing power parity, real effective exchange rate, the Big Mac index, they all tell you that the yen is anywhere from 30% cheap to 50% cheap. That is reflected in real world behavior. Tourism numbers are booming because Japan is now a cheap place to visit. You would not believe the stories and the prices that you hear of people coming back from there. So cheapness is a nice place to start. We're drawn to that. But cheapness doesn't tell you anything about a catalyst or when you should own something. And we have to admit, we've been early on the yen. It's been painful for us in the last 2 years because that's when we started to build up the big position. But we now have the catalyst. Over the last couple of years, what has driven the weakness is monetary policy divergence. So fancy phrase, what that means is the whole world was raising interest rates and the Bank of Japan was sitting with negative interest rates and doing QE. So the yen was weakening to reflect that. Today, it's going into reverse. The Bank of Japan is raising rates. It is winding down its QE program, and the rest of the world is beginning to move into an easing cycle. So the interest rate differential that has been painful to us is now heading in our direction. That's a big positive and has probably driven the first 5% of the yen appreciation. The second element is the unwinding of the carry trade. Now, the carry trade has got a lot of press through August. Carry trade means, in this instance, it means when you borrow in yen, which is possible at effectively zero rates, and then you take that money and you go and buy overseas assets, be it an office building in New York, or be it speculating in commodities, or possibly buying the S&P 500. As and when you get either yen appreciation or a risk market wobble, the leveraged speculators engaging in the carry trade have to then sell their risk asset, whatever that was, turn around and buy back yen to pay off their yen debt. And that creates a sort of panic into the yen dynamic. We saw a little bit of that in early August in the market wobble, and we saw the violent moves in risk assets that caused, but they were fleeting. We think that the carry trade is impossible to calibrate the size of it, but we know it is enormous. You get a range of estimates anywhere from sort of 2 trillion to 10 trillion. But this is a dynamic that's been building up since 1990.
Why doesn't the Bank of Japan or the Fed or the IMF or the Bank of International Settlements not know the size of the carry trade?
I think it's too diffuse, because you have individuals on their IG index account doing it. You have Mrs. Watanabe doing it. You have Japanese corporates. Warren Buffett sort of did it by issuing bonds in yen. So there are far too many parties engaged implicitly or explicitly in the trade to get a sense of the size. And also, layer on top, Japan is the largest foreign net asset position in the world. Japan owns more external assets than any other nation. That too is sort of a form of the carry trade. So if the yen starts to rally, which is happening, then we believe that these people will start to book their profits. And some of these profits will have accumulated hugely over the course of decades. So even a little bit of volatility recently might be the catalyst for them selling, but they're still going to be happy to do so. Bring that asset home, which will involve squeezing up the yen. So the portfolio role for us is very important. We thought that the yen would act a bit like a wrecking ball through global risk assets, because the yen rising forces the selling of risk assets, which forces buying of the yen, which forces the selling of more risk assets. And that was somewhat vindicated by the moves in early August, but we've retraced most of them. But I think that demonstrated that if the yen is going to be the cause of the market's problems, then having it in the portfolio is going to be very, very helpful. So we've got about 15% of the portfolio in yen.
Sorry, you've got what?
15.
But the yen has been appreciating again in the last few days, as I'm sure you're aware. And that, so you obviously don't feel that we're near the end of this unwinding of the yen carry trade.
Not at all. No. The very fast money. You saw a lot of the speculative futures yen exposure unwind in what we saw in early August. But the real money cannot possibly have moved. This has been going on since 1989. The idea that everyone's got their books balanced and right
in a month,
in the course of a week, in early August is preposterous. And the level of the cheapness that I talked about earlier, we've seen a maybe 5% move in the yen, 7% move in the yen from the top. It's up to 50% cheap. So I think we've maybe seen a quarter of the move, but the big money hasn't moved.
We talked about the yen and its attractiveness, the impact it has on arguably the stability of the global financial system. What are the other mechanisms you use to protect the portfolio?
We've always been quite creative in terms of how we try to build that protection side of the portfolio, whether that is pre-financial crisis, we had a very large allocation to the yen again, and also the Swiss franc, because the same carry trade dynamic was playing out pre-financial crisis. You had the same setup, 0 rates in Japan and 5% rates in the West, so that the same thing happened, and the squeeze back into the yen happened. So that was a pretty out there position back then. Of course, portfolios are much more global in 2024 than they were in 2007. So that's less out there now. We've used Bitcoin in the past, but really what I think we're known for is what we call our unconventional protections. And they are probably the biggest differentiator between us and our peer group. We started this effectively derivatives to create the protective side of the portfolio. Because when you're seeking to create negative duration, so that's an asset that will go up when interest rates go up, or negative correlation, something that will go up when risk assets go down, that is much easier to find in derivative land. Long-only assets can sometimes perform that role. So yen, bonds, gold. But as we saw in 2022, sometimes they fail to diversify. And so we have built out over more than a decade now this derivative expertise. We've used equity put options, volatility call options. That allowed the FT to do that article where they compared Jonathan Ruffer to 50 Cent. I think they just wanted to use a photo of the two side by side. The credit protection, so using CDS to express a view that credit spreads will widen, corporate borrowing costs will rise. And there's a trade-off here. If you have a direct risk in your portfolio that you're worried about, say US equity exposure, because we are unbenchmarked, because we have the benefit of being unbenchmarked, you could just sell it. You could just get rid of the risk that you're worried about, or you can hedge it. And if you choose to hedge it, then you have a choice of, do you go for a direct hedge? Do you just use an S&P put, which will be effective? You'll know exactly what you're getting, but it's probably quite expensive. Or do you use a more oblique hedge? And that's things like credit spreads or volatility call options. And the more you venture down that path of obliquity, the more basis risk you take on, but also the more cheapness or asymmetry or convexity you are likely to get. Those are the nature of the discussions that we have as to how oblique do you want to be? Because if you're too oblique, then you might end up being a little bit too clever in your hedges, not hedging what you want to hedge.
What about the UK? Is it a safe haven or is it a value trap?
I think it's somewhere in between. I'm not sure I'm bold enough to call it a safe haven. I have been and remain very bullish on the UK's prospects. I think it's probably still the most interesting equity market in the world. Some of my colleagues might disagree with me on that, but we have 10% of our portfolio in UK equities. The sector composition is something that's really hurt the UK. As we all know, we don't have any magnificent tech companies, and that's been to our detriment. But today, I would say the sector contribution might actually be helpful. We have lots of real assets. We have commodities, we have energy, we have house builders, industrials. The political omnishambles that we've had for the last decade has, at least for the moment, touch words, receded. And
it's changed shape, I'll give you that.
Yes, that's a very nice, euphemistic way of describing it. It has very much changed shape. But at least there is some element of certainty, and we know the markets hate uncertainty. The valuation case has been there for several years. It remains at the FTSE 100 level. I think we're about 40% discount to the US. The UK smaller company space, as several of your guests have highlighted, is incredibly attractive. But we have the catalyst now, because just like the yen, valuation means nothing unless you tell me what's going to change the situation. And I would put the catalyst into two parts. The first is flows. We've had a decade of relentless outflows from the UK ever since IndyRef in 2014, but particularly since Brexit. I forget the numbers, but it's something like every month but 3 since Brexit has been negative for the UK.
And it's ongoing. It's just slowing down.
It's slowing down.
Yeah.
The wealth managers and so on that have globalized their portfolios over the last decade must be mostly sold by now, mostly reorganized. And then you have the M&A angle, which has really picked up in the last 18 months.
Yes, and the share buybacks as well, I guess. In terms of looking at the flow. Someone said to me a few weeks ago, a friend of theirs, so this is a very third-hand story, worked at one of the big consultants, Tower Watson, someone like that. He didn't name which one it was. He said one of the big London consultants. And he had an incoming call from a US wealth manager or family office saying, we want to put out an RFP for a UK active equity mandate. Could they put them in touch with somebody, from this big consulting firm to organize it for them? So he said, leave it with me. I'll make some calls. I'll come back to you. And he said he discovered that they'd closed the department 6 years previously.
but no one had asked for one in 6 years.
Yeah.
I can totally imagine it. We saw another UK fund closure this week. without naming names. So there's a capital cycle angle here, isn't there?
Yeah.
And the capital cycle for the UK looks really good. The M&A drumbeat is relentless. Hargreaves at the top and lots of smaller companies at the bottom.
But there's a much cheaper market out there, isn't there? A much bigger market, a much cheaper market. And we've talked about it already, and that's China.
Yeah.
Is it investable? You must think it is, because I think you have some exposure to Chinese equities in the fund. But my little capsule of factoid here is that, from what I can gather, since joining the WTO in 2001, the Chinese economy's grown 12 to 15-fold, been remarkable. If you'd invested over that period, you're probably not made any money at all. Certainly not made a real return.
I read that stat the other day and I had to fact check it because I didn't believe it.
It's broadly right, I think.
Over 30 years, MSCI China is flat.
Yeah.
Which is remarkable because in that time, like you say, they have lifted hundreds of millions of people out of poverty and become a global superpower. I frame our portfolio at the moment as a collection of ugly ducklings, and I think China is the ugliest duckling of all. We've got about just under 5% of the portfolio in Chinese equities. You said the word uninvestable. That is a common reaction to our holding. But I think that uninvestable is one of the best words you can hear as an investor.
Yeah.
Because it's like hearing the word never. I'd never buy that. It is closed-minded with some justification. I mean, I'm not belittling the bear case on China. It's very real. But uninvestable is a closed-minded approach, and we encounter it all the time. Let me tell you a secret. We are all long China anyway, just at a variety of different prices. China is 20% of global GDP. It is probably the only complete, fully integrated supply chain in the world, and it is deeply involved in every global supply chain. If you own NVIDIA, you're long China. If you own Tesla, you're long China. Caterpillar, Starbucks, LVMH, these are all China proxies, but you are long China at 2 to 3 times the valuation that you would be long China if you bought Alibaba or Tencent or Prosus and these things. I think the sell-off on August 5th showed just how unloved Chinese equities were. They were flat on the day because if nobody owns them, then nobody can sell them. I think it's as simple as that. So I think of it as, if we are right about the world, that's Cold War II, that's increased geopolitical fracturing, then Chinese equities are probably not a great place to be. And you will continue to see them annexed from Western portfolios and Western capital flows. But if we are wrong about the world and geopolitics actually does calm down, and if global GDP is going to be better than we think over the coming decades, then reintegrating the world's only other superpower is probably part of that. Then Chinese equities are trading way too pessimistically. I think that if we're wrong, it will do pretty well. And in some of the worst case scenarios that are the reasons why people don't own these, then yes, we will do badly with our Chinese equities, but the rest of our portfolio will do very well. So gold, oil, volatility call options, equity puts, these will all do well in the scenarios that are the most negative for China.
That makes sense. Just sort of more holistically, looking as I was in preparation for the chat today at the performance of the Ruffer Investment Company since launch, it's in your annual report. There have been 3 obvious periods where the fund has underperformed the FTSE All-Share. And that was 2006-7, 2018-19, and as you referred earlier, 2023, 2024, like now. In both the previous periods, the market corrected substantially in the following period, 2008 and 2020. Now, on that basis, just statistically, 2025 doesn't look good.
Yeah, we are positioned for markets to do badly, certainly less well than people expect. And there is a history of Ruffer leaving the party early. So we've treaded water for a couple of years before each of the major market inflection points and then been vindicated. I really hope that we will have a similarly sort of redemptive performance moment in the near future. It is, I never know whether it's a feature or a bug. We have this tendency that our performance at these inflection points comes a little bit like getting tomato ketchup out of a glass bottle. You sort of slap on the bottle and nothing happens, and you slap again and nothing happens, and then on the third slap, you drench your chips with too much tomato ketchup. And I think we will have a big relative and absolute performance moment. I'm less certain about the timing. And that's just because we have a portfolio that looks nothing like anybody else's. It looks nothing like the benchmark. And when the investment weather turns, I think it will be pretty dramatic. And we saw that in microcosm in early August, but of course the market put itself back together. It may not be the top of the market right now, but if it was, how would we know? History doesn't repeat, but it rhymes, that sort of thing. And I mentioned a few of them in the Ruffer Investment Company annual report. Up until very recently, we went 380 days without a 2% down day. The S&P trades on 21 times forward earnings. That is very high relative to history, although I'm amazed by how many people think that is now a normal valuation. That's why the equity risk premium is at a record low, because that is a very high valuation. We saw record flows into tech stocks in May and June. Nvidia added $1 trillion of market cap in 6 weeks. Berkshire Hathaway has just achieved $1 trillion of market cap, and it took Warren Buffett 61 years versus 6 weeks for Nvidia. And really stretching the anecdotes, there's this tendency of rock star CEOs, isn't there? That iconic photo of Jensen Huang signing a lady's, this is a family show, so we'll say signing her T-shirt at their investor day.
Although I think she'd removed the T-shirt.
These are just not things that happen at the bottom of markets. These are things that happen at the top. The new Starbucks CEO's compensation package, $100 million to work from home along with a private jet when he chooses to show up to the office. In 2021, we all chuckled at the insane money being sprayed around by crypto and venture capital-backed companies that WeWork was pretending to be a tech company rather than a property company. There's lots of similar examples today. I'm just surprised that these things are still happening now that rates are 5%. I genuinely believe this was a zero interest rate phenomenon, and that's been wrong. So if in a few years we look back and we say, how could we have known that there was an echo bubble in 2024 with an investor complacency off the charts, then it's fair to say there were a few clues. And I think one little factoid on that complacency and willingness to compartmentalize wobbles is that when the VIX index goes above 35, historically it's taken 6 months for markets to calm down again and the VIX to go back below 20. In early August, it went to 65, not 35, 65, and it was back below 20 within a week. Nothing to see here.
A lot of this reminds me of the conditions we had, of what I can remember of them anyway, of 2007 or 2006-7. I mean, I think it was 2007 we had Northern Rock. Then the US, I think it was Washington Mutual. It was certainly the HSBC subprime subsidiary went a bit pop. And then the few hedge funds that no one had ever heard of, some French bank credit funds, started not being able to make redemptions or meet obligations. And everyone just sort of, the dustpan and brush was brought out and the media, it was all swept away and everyone said, no, nothing to see here, nothing to see here. And probably within 12 months, it all looked very, very different, but all happened very, very quickly. And everybody, was then saying, well, that was totally unexpected. It was that time when we first heard of what a black swan actually was.
I've talked about these things being a process rather than an event. Yeah. But there's no doubt that we have to admit, if it is a process, it's taking longer than we thought. But as you just laid out, the financial crisis was 2 years. Well, it was longer than 2 years in the making.
Yes, it was.
Signs were there that it was happening in 2 years. I would maybe make a slight distinction this cycle that rather than hedge funds and the alphabet soup of MBS and CDOs and all that stuff that caused the financial crisis, which Henry Maxey, our CIO, was very astute in observing at the time. He wrote a book in 2006 called Cracking the Credit Market Code, which nailed the coming financial crisis. But the difference this cycle is that so much of that is now happening in privates, isn't it?
Yeah, you can't see it.
So private equity, private credit, maybe that's where the gremlins are lurking now. But they have the luxury, as Cliff Asness keeps pointing out, of volatility laundering.
You mentioned earlier your foray into Bitcoin. I can't not ask you this question while you're here. How do you think about Bitcoin now? You obviously did I want to call it trade, but it was an investment that went right quicker than you probably expected. I don't know. What is Bitcoin, and Does it represent a digital real asset, or is it merely a speculative tool?
At Ruffer, we are currently no coiners, so we have no Bitcoin exposure.
Yeah.
I personally have no Bitcoin exposure anymore. I sold at the same time as Ruffer did in 2021. Yeah, we did very well in Bitcoin, and we made a lot of money faster than we expected to. So what is Bitcoin? It's not digital gold, but I think the right way of thinking about it is that it remains an option on becoming digital gold in the future. It might be digital gold for millennials and Gen Z, but it's not digital gold for boomers, if you want a sort of shorthand for that. I do think Bitcoin is becoming Lindy, if you're familiar with that sort of mental model, which is something I learned in the crypto world. It's based on shows on Broadway. And so when a show gets its first run on Broadway, it is highly likely to not get a second run. Most shows flop. But if you make it through your first run and you get a second run, then you must be quite good. And if you make it through your second run, you're very likely to make it to a third run. So for each additional period that you endure, the probability of surviving the next one increases. And then you get to shows like Les Mis and Cats and Wicked or whatever.
It's resilience, right?
Yeah, that will be around forever. So for each period that you survive, your likelihood of surviving forever increases. And I think Bitcoin is becoming Lindy. It has become part of the financial system.
Is that a good thing or a bad thing?
I make no value judgment. I make no value judgment. It is. I mean, I do think it's ironic that it is sort of counter to the original purpose of Bitcoin, isn't it?
Absolutely, yeah.
The Bitcoiners who wanted to subvert the financial system, I cheer the arrival of...
The same is true of the internet. The internet was originally formulated, or not formulated, but originally championed by the libertarians of California, and it was freedom personified, and they're probably all working for Google and Facebook.
Yes, exactly. I think there is definitely an irony there. In terms of valuing it even harder than gold, the framework that we used at the time, or one of the frameworks, was Bitcoin was worth $200 billion when it was $8,000 in 2020.
Yeah.
At that point, gold was worth $10 trillion, or the estimated value of all the gold in the world was $10 trillion. So I simply posed the question, is there a 2% probability, 200 billion over 10 trillion, that Bitcoin might replace gold? And we think the gold number is going up as well because we're bullish gold. That seemed a reasonable guess. And I said, what if it gets to $50,000? That would be a 10% probability of it replacing gold. That seems like a reasonable guess at the upside. So if you update those numbers to today, Bitcoin is worth about $1 trillion, 1.2 trillion, and gold is worth 15 trillion or thereabouts, supposedly. So now you're looking like more of a 7 or 8% probability of it replacing gold. That to me feels closer to fair, but maybe also feels a bit low, given all of the positive steps and developments that we've seen, some of the things that Donald Trump has promised to do if he gets into power, a sovereign wealth fund for Bitcoin for the US, things that you never previously would have been able to imagine, even just 2 or 3 years ago. So no position personally on Ruffer, no intention to have a position anytime soon, but I do keep an eye on it because I think it's just...
I like the evaluation framework. That makes a lot of sense and is probabilistic. And to come back to your starting point about being, you have to be humble in this world. You don't know what makes it work or where in fact it's going. I'm a big fan of Taleb, Nicholas Nassim Taleb. I don't know if you've read his books.
Yes, I've read the first 2. I think he's got a bit crazier as time has gone on. So I've not read books or what.
There's a lot of crazy. Yeah, well, I can't remember which of his later books it was, but in one of them, he, to your point on the Lindy effect and the survivorship of Bitcoin, he said that not everything that happens in the world happens for a reason, but everything that survives for a reason. Yeah. That's what I think Bitcoin is, and what the internet is, and what our money is, and what our language is. These are emergent phenomena that no one... Well, okay, in the case of Bitcoin...
You're sounding like a Bitcoiner here.
The summer of 2020, when you were looking at Bitcoin, I wrote down these principles, and the first blog post I wrote, because I then started writing a blog, was prepare for inflation. And in that, I said, you need to have exposure to real assets. That's when I first bought gold, and it's when I first bought Bitcoin. And shortly after that, I bought uranium. They're the real assets.
Yeah.
And I still own them today, and they've all done nicely, but Bitcoin's done better than all of them.
Well, that's interesting. When I sold Bitcoin, I bought uranium. One of the things that they can't print.
Yes.
That's a really not bad one-sentence investment philosophy for the coming decade.
What about other things they can't print? I mean, the other asset I bought that's done less well with the same mindset was I bought a little company called Artisanal Spirits, whose principal assets sit not very far from where you are.
I know it well.
They're in the form of cask single malt whiskey,
yes,
which sounds delicious and seems pretty bulletproof to me, but the shares have halved since I bought them.
In 2021, I wrote in the Ruffer Review an article slightly having a dig at the consumer staple darlings of the day. So Diageo, Unilever, Nestle. I think I also mentioned LVMH. I even had the temerity to have a pop at Lindsell Train, who were the ultimate beneficiaries of that trend at the time because they had a phenomenal track record. But today, all of those stocks have massively derated, and we now own Diageo and Unilever and MacInnes.
Interesting.
And you mentioned Artisanal Spirits Company. That's too small for Ruffer, but
sure.
Stocks like Artisanal Spirits Company, Laurent Perrier, Rémy Cointreau, these all trade for below liquidation value. And there's a nice pun there. But they all trade for a fraction of their liquidation value, and the assets on the balance sheet should be appreciating. So I think if you buy and close your eyes, these sorts of things, if appropriately managed, are probably very attractive on a long-term horizon. If you own a luxury spirits company in a recession, the business might not look great for a while. You need to make sure you're paying a reasonable valuation. But to come back to the idea of lindiness, these brands have been around for centuries.
What advice would you give to anyone thinking about becoming a professional investor today?
It's quite common for people to say to this, don't join the investment industry, go and do something productive with your life, go and be a doctor or a scientist. And I can see why people say that, because most of the financial industry are rent seekers, passive investment, which is ever growing, parasitical force on the work of others. But I think that we have the best job in the world. What markets sit at the intersection of psychology, economics, history. Accounting is maybe less fun. There's some accounting in there, some valuation. You get the privilege of learning a little about a lot, or going really deep and specializing in something that you find fascinating. So there's not many jobs where you get to behave like a magpie, scanning around, looking for things that look shiny and interesting, and then swooping down to check it out. You get to travel, you get to visit companies, you speak with really smart people, and you get to find out how the world works. And you get measured in real time, which sometimes is fun and sometimes it's not.
Yeah.
I think it's a great industry if you can be passionate and interested in the subject. But to do so, it will require an extraordinarily competitive process to win. And I wrote my blog to try and differentiate my CV, to demonstrate that I had a way of thinking about investments that was maybe a bit different, less conventional than just what you learn on the CFA, and that maybe I could add some value. I think people have to do that. I didn't really have any work experience or internships or anything like that. So I really had to do it another way. That was my approach. But yeah, I'm very encouraging of thoughtful young people joining the industry.
I think you said something very interesting there, is that you said that you had to be passionate or be interested in markets, history and psychology. And you did mention accounting in passing, but you didn't mention spreadsheets and mathematics.
If your Excel spreadsheet has 9 tabs on it, you've probably gone too deep.
Absolutely.
There's an illusion of precision. Like you said with the Taleb quote, the world is really messy.
Yes.
And you're kidding yourself if you try and forecast accurately over longer periods or just in a very messy and unpredictable world. So
it's better to be broadly right than precisely wrong. Thank you so much for joining me today. It's been absolutely fascinating. I've loved it. As I've said to you before, I'm an investor in the Ruffer Investment Company. So I'll be marking your homework going forward, Duncan. I very much look forward to having you back on for a chat sometime in the near future.
Thank you very much for having me. It was very interesting.
Brought to you by Progressive Equity.